This WISE review is going to cover the content area of insurance. Insurance is designed to protect you, the insured, against a financial loss due to something happening. Now, it could be something happening with your car. You have a catastrophic loss due to some kind of accident. It could be healthcare costs that you're insuring against. You could be insuring your property, whether it's just as a renter or as a property owner where you own the actual building too. You can even get life insurance to provide money to people you designate should you suffer an untimely death. Insurance companies are designed to pool together people to share risk, and that's why you get the insurance. Insurance companies will build a risk pool of a whole bunch of people who wish to have the same type of loss insured against. Now, the insurance company knows that not everybody is going to suffer that loss. They know that it's only going to be a relatively small number of people amongst their entire risk pool. What they're going to try to do is predict the likelihood that that loss will occur for an individual and what the severity is. And then they're going to figure out how much they need to charge everybody in order to cover the losses that they anticipate experiencing. The insurance company is going to be the one providing the insurance. The policy is the actual contract for the insurance. In the insurance policy, the events that are going to be covered, in other words, the coverages, are going to be stated. There will also be limits set on how much the insurance company will pay out for each of those type of events. It'll also state what your deductible is. The deductible is the dollar amount that you'll have to pay out every time one of those events occurs, and the insurance company is going to have to pay out to cover it. The policy will also state what your monthly payment is. It's your premium. Now, this premium is going to be set based on risk. What's the likelihood that the event is going to occur, and what's the severity of the event should it happen. If an event does occur that you're insured for, you'll file a claim. The insurance company will either pay out on the claim to whoever it is that you owe the money to, or you'll have to pay out and they'll reimburse you. Generally, though, they actually pay out whoever it is you owe money to. Main type of insurance you're probably going to deal with is auto insurance. You can get auto insurance to cover what happens in accidents. Now, if you want your car covered, you have to get collision coverage. This is what's going to cover your car should you be at fault in the accident. You will have to have automobile liability insurance because this is what covers the other person's car as well as any bodily injury that they suffer if the accident is your fault. Remember, if the accident is not your fault, they're the ones that are going to have to pay. You can also get insurance for non-accidents. Your car getting broken into, your car getting stolen, vandalism, acts of nature that do damage to your vehicle. You can get insurance for this and what's called comprehensive coverage, which is just basically something that happens to your car that is anything other than collision. Now, your premiums are based on several factors. First off, age, gender, marital status. Younger will pay more than older. Males tend to pay more than females, and single tend to pay more than married. It's all based on historical precedent on who normally files claims or for how much, and they get to set their premiums on that. And that's what the statistics normally show. It's also based on what kind of car it is you're driving, as well as how much it's going to cost to probably repair that car should the accident occur. They even look at your driving record. Do you have any tickets or accidents? Because if you do, it generally indicates the likelihood of the incident occurring is higher. Now, you can do things to keep your premiums down. First off, set your deductibles pretty high. Since the insurance company has to pay out less for any claim, they're not going to charge you as much in your monthly premium. Driver's Ed can actually help keep your insurance premiums down as a young driver. You can also do things like get security alarms, keep the thing in a garage. That limits the likelihood or severity of theft, getting it broken into, damage from weather or anything like that, as well as obviously keeping your driving record clean. All these things can go to keeping your premiums lower. Health insurance will be another type of insurance you're going to have to deal with because you are now required to have health insurance. Your health insurance will have two parts to it. First, there'll be the routine medical care part, which covers your typical doctor visits, prescriptions being filled, those kind of things. With each of these kind of things, you generally have a copay, which is just a small dollar amount you pay out of pocket every time you have to go visit the doctor, get a prescription filled, whatever it might be. This is different from the other part of your policy, which is the major medical care. These are for the more catastrophic things, the illnesses, the injuries, surgeries, emergency room visits, physical therapy, or other outpatient treatment that you might need. Now, with these kind of things, what generally happens is for every year, you'll have to initially pay what's called a deductible. That's some dollar value, several hundred, if not several $1,000s, out of pocket before the insurance company starts paying for anything. And once you've met that deductible, you'll have some co-insurance requirement, which is a percentage, normally 20%, of the remaining balance beyond your deductible once you've paid the deductible that you're going to have to pick up for every bill until you reach a maximum out of pocket for that year. Now, in order to be able to keep your health insurance premiums down, you can set your deductibles higher and your co-pays, because what that's going to do is lower your premium. The more you agree to pay out of pocket, the less your insurance company is going to charge you every month for the insurance, because their liability that they're going to have to pay is less. Where do you get insurance? Well, you get it from some kind of network provider. The two main types are preferred provider organizations, PPOs, or health maintenance organizations, which are HMOs. Now, they're referred to as networks because what these insurance companies have done is build a network of healthcare providers that they have contracted with to provide you your full set of healthcare services for set amounts. Now, preferred provider organizations, the premiums tend to be a little more expensive because they have a lot more doctors in the network, as well as they allow you to go out of network and see a doctor that is out of network and still pay at least part of that bill. The health maintenance organization actually is a little bit cheaper in your monthly premium because what they do to keep their premiums down is narrow the list of network providers that they provide. They also generally require you to go through a primary care physician to get all your treatment directed, and they don't allow you to go outside a network and expect to have them pick up the cost. You can still go outside the network to see a doctor of your choice, but if they're not part of that HMO network, the HMO will not pay anything for that bill. But you can save money on your premiums by going with an HMO. It's really just a decision you have to make. Would you rather have more availability as far as the number of doctors and the ability to go out of network, or would you rather keep your premiums lower? Life insurance is generally designed or bought so that you can provide for whoever you designate to cover any expenses that you may want them to have money for. Generally, it's done for funeral expenses, replacing lost future income, paying off existing debt, and paying for children's education. It can be any one of these, any combination of these, or really just whatever you want the money to go for. Whoever you designate the money to go to is referred to as the beneficiary. It can be one person, it can be several people. The two main types of life insurance that are out there are term life and whole life. Term life is only for a specified amount of time, 10 years to 30 years normally, while whole life is for the entire life. Now, the premiums on term life tend to be much lower than whole life because it's just a matter of if they're going to have to pay during that time frame, and they're calculating the likelihood of that happening. With whole life, they know they're going to have to pay. It's just a matter of when. So they're generally going to charge you more because they know they will have to pay out. It's just a matter of when they think they're going to have to. The thing about a whole life policy that's different than term life is it will build up a cash value over time. And should you decide to cancel that policy before you die, you can cash in that cash value and take that money and use it for whatever you want. Property insurance is the last type of insurance we're going to discuss, and you can get it as a renter or as a homeowner. There's some commonalities between the two policies. First, both are actually going to cover your stuff, your contents. They're also going to provide you a certain amount of liability coverage. This is kind of like with the auto liability, but it's for any other damages you might do to somebody else. The big difference is, though, is homeowners also covers the structure. It'll cover the house, it'll cover the garage, sheds, any other outbuildings, fences, pools, and those kind of things. You don't have that with renter's insurance because it's not your property. The property owner actually needs to insure those physical structures and all that. You really just get your coverage for your contents and for the stuff that you have inside, as well as the liability. Now, the contents coverage can either be actual cash value or it can be replacement cost. The big difference is with actual cash value, what they do is figure out what's called the depreciated cost. They'll figure out depreciation, in other words, loss of value on your item, And depending on how old it is, they're just going to pay you some lesser amount from what its original value was, what they consider the current depreciated value. With replacement cost, they're actually going to give you enough money to buy a new equivalent item. Now, if you want to save money on a monthly premium, you might want to go with actual cash value. But if you want to make sure you get enough to be able to buy brand new items to replace the ones that you lost, you probably want to consider replacement cost, even though it might be a little more expensive. That concludes this review.